I'm Jason Wong, Research Manager from FSMOne Malaysia, and we are very privileged to have with us here today Ms. Noor Hanifa Hashim, who is the CEO, Head of Malaysia Fixed Income and Sukuk for Franklin Templeton Fixed Income Malaysia. Ms. Hashim is responsible for leading fixed income in Malaysia and developing investment policies for the Malaysian market. She collaborates with the global teams to support global fixed income capabilities and helps to identify market trends to increase Franklin Templeton Global Sukuk Committee's market penetration in Malaysia. Ms. Hashim has over 26 years of experience in the financial services industry, and prior to her current role, she was an executive vice president for CIMB Principal Asset Management Berhad or Investment Bank. She was also previously with Sime Darby Berhad. She joined Franklin Templeton in 2011 as head of Malaysia Fixed Income and Sukuk. Ms. Hashim holds the Bachelor of Science in Economics and International Relationships from the University of Wisconsin-Madison. She is also a national member of the Financial Market Association Malaysia and obtained her Capital Markets Services Representative License, CMSRL, in 2004. Dear audiences, today's session will be in Q&A format, and we'll take questions from the ground towards the end. So please feel free to post your questions in the chat and we'll pick them up later. Let's start the Fireside chat right now. Hanifa, are you there?
Yes. Can you hear me?
Yes, I can hear you very clearly. So let's start the session right now. I think some of our audiences would be interested to know how the life of a fund manager is. Would you be able to share a bit on what you do on a day-to-day basis as a fund manager, and also what keeps you up at night as well?
Okay, right. Thank you, Fund Supermart, for the invitation tonight. I'm very happy to be here. For as a fund manager, I think we are looking at all the global events. Whatever happens in the US, Europe, China, will affect us. So I think the life of portfolio manager, you have to basically remember, basically follow all this, what's happening in the world locally as well. So yeah, and that's sometimes make me awake at night, especially now. The way market move is following the the trends of US Treasury. Basically, every morning we'll see what's Treasury closed last night, because it's really influenced by what's happening, especially for now in the US.
I see. So closer to home back in Malaysia, so let's talk about the Malaysian Sukuk market. So since it was brought to introduction 30 years ago, so Sukuk has enjoyed quite a substantial growth within Islamic finance, and also the Malaysian Sukuk market has grown leaps and bounds over the years. So do you have any interesting facts or trends about Malaysian Sukuk that you can share with our viewers?
Yeah, you are right. Sukkot have been, growing in double digits, every year. Well, they'll set back along the way. Yeah,
Wow.
but yeah, and I think, for Sukkot market, I don't know whether, investors out there or capital marketplace know that it's actually, in terms of Islamic Sukkot is above 1 trillion, ringgit. Yeah, above 1 trillion ringgit, out of about 1.4 of the total bonds. That's about roughly about 65%. And if you look at the corporate sukuk specifically, the companies that actually tapping the sukuk market, mostly 4 times more than conventional. So most corporate sukuk are most corporate bonds are in the sukuk format. So it's basically the growth. And I think, not just growth, I think in terms of return as well, why Sukuk? Because, the returns have been, pretty much, of course, as a bond, they also follow, what happened, like I mentioned, what happened treasuries, you follow in tandem. But, one thing about Sukuk, in terms of return wise for the past, years, basically it's more stable, kind of, because it's actually quite technical, because, the
Mm-hmm.
demand for Sukkot is basically the demand supply, right? So a lot of us, or a lot of the investors are changing towards Sukkot, basically.
Oh,
So I think, yeah, so, so in terms of the, basically the, the demand is more than supply. So that actually, kept Sukuk pretty much in terms of return, is higher. So I think, I also want to, mention, this trend that I see, happening now in terms of the increasing number of retail and high net worth participation. Actually, I think, since 2020, when, what do you get for, a 1 year FD? 1.8, less than 2, definitely, right?
yep.
So yeah, so a lot of, investors, retail, high net worth are actually tapping, started to invest in, corporate Suko, that give you probably decent, for half, 5% return. And,
Wow.
and yeah, so, and I think, I
Okay.
don't know whether the market know this, but, you can actually, the issue before is that, oh, the retail don't have, enough information, basically lack of information. That's why, but actually now, other than, you can also, start to monitor bonds through the Securities Commission, arrange, well, led website called, Bond Information Exchange Malaysia. All the
That's Big's
informations,
Malaysia, right?
yeah, Big's
Big's
Malaysia,
Malaysia.
and all the informations are there. So basically, and, and we as, institutional players, we need to pay. So, actually, if you tap, and look at that, sufficient information, you can get, pretty much, a lot of things, covered in the Big's Malaysia website. Yeah, so I encourage, investors out there who are interested to basically know more about bonds, to actually just, try to, look up, the website.
I think this Big's Malaysia is a very good initiative by SC to try to educate our retail investors more about Malaysian bonds and Malaysia Sukuk. Definitely,
Exactly.
it's
Yes,
very
exactly.
useful. You can.
Very
Oh,
useful. Yeah. So, and I think, there's a lot of effort put, into that. I'm involved as well.
oh,
To
okay.
Yeah, that's right. To actually, give feedback from investors' perspective. What,
That's good.
yeah, what actually, in the beginning, it's been a few 2 years probably now. In the beginning, to basically give, what would like what retail investors would like to see. So we want to share information. So, so that we are able to increase further the retail participation through the funds, or, because I think direct investment in bonds requires 250,000 minimum, right? So I think you can also do that through funds, managers like us.
That's good. That's good. You mentioned about 2020. So after the unprecedented events of
Mm.
2020, do you see Sukuk being more resilient during 2020, the stress that happened?
Well, I think, basically for the Sukuk market, it also move, in a way, because when yield is, is behave like conventional, but like I mentioned, just now, in terms of the, movement, it's kind of more, guarded, it's, more stabilized. I think, if you, I think if you what we experienced, in first quarter was, we call steepening of the yield curve. So I think, to describe this steepening, because you're going to, keep hearing the steepening of the curve. What is it? So I think, you can imagine, if we look at the, slide just now in terms of the curve. So, basically, you imagine a mountain, that probably, and a hill. So, so the long tenor represented by the mountain actually move higher, whereby the shorter ones, which is the hills, stay, constant. So, in terms of, so the long yields move, but the short yield, 3 years, as, represented by slide 2 just now. So basically, on that, it's a lesser impact. So it's lesser impact on, on the, light blue, for example. You can see, towards the April, for example, very small movement there, but you see the dark blue. is actually, more steeper, they call it. So that's steepening of the curve. So basically the gap between the short tenor and the long tenor. So, if you imagine you are on top of the mountain, at, for example, on the dark blue, your risk is more. You have more risk, right? Compared to if, compared to if you are on the shorter hill, which is the light blue. So that's, just to have some analogy in terms of what steepening of the curve means. So it rates move, but it's not in tandem. If you are in the mountain, it actually move more. But if you are positioning your fund in the short tenor, which is the 3 years, or we call it in the medium term. So actually, the movement is pretty much and I think maybe about 20 odd basis points.
I see, I see.
Yeah.
So during the steepening of the yield curve, how did your fund manage to ride out this volatility?
Yeah, so I think, imagine again, if you are in the mountain, I'm at the base camp. So, so I didn't, go up all the way to the peak, so as a result, because of my positioning in the, in the base camp, in closer to the ground, so because of that, the fund that we manage, is basically, can withstand the, the movement that I mentioned just now. So, and I think, it's also added because I think, using analogy again, for us, we have the right tools, meaning that for the bonds that we have, we have the right bonds, if you see, slide 3, for example, first quarter is also double whammy because there's a lot of credit downgrades. But for us, I think being part of the global, organization, we collaborate and we actually integrate with the our global teams in terms of credit, especially
Mhm.
sector. So that kind of give us the benefit. So we got, we all, most of our funds are short duration, we call it the short tenor, right? And then
Yeah,
in terms of credit as well, we do not we don't have any of this that downgraded bonds basically. So I think that,
that's good.
yeah, so that is probably our our strength in terms of managing this fund as well as the whole fixed income for
I
Malaysia.
see. So
Yeah.
you managed to basically avoid all these downgrades thanks to your, I would say, your team's credit analysis, I would say.
Yes, that's right. So I think, if we move to slide 4, there's basically, sorry, the next slide, just to describe about the, our credit strength.
Sure.
So yeah, so basically, I think for us, we have not been able, we have not really experienced, even a credit downgrade,
Wow, that's
so
good.
yeah, so I think, in fact, I think because of our global, you know,
Expertise.
yeah, global expertise, we actually take advantage, so, if we move to the next slide, I think, sorry, the slide on the downgrade. So basically, I think, yes, sorry. Okay, so I think basically, what we have is that, we are able to take advantage of some of the, some of the issuers. For example, Lafarge
Okay.
Cement. Yeah,
Yeah.
so, it's Paris-based, right? It's French company.
Mm-hmm.
So, that have a presence in Malaysia. So, when they actually tap the market, we saw that that the we collaborate and we ask our London guys, and that how do you think about this credit, and they said Malaysia is a very important to the overall Lafarge. So we actually took advantage of it. It was actually have a downgrade after that, but it's at the price that it wouldn't move, because at the beginning it's already sold at at credit that is not commensurate. So it's already pricing in like a single A. So I think for us, we are able to take advantage because of our, global kind of. So we do take credit risk, but really, if we really have a conviction because of our global presence.
I see, I see. Other than that, what about the local team? What are the key items that you look at to tell whether the Sukuk is good or not? Could you
Oh,
maybe
yeah.
elaborate a bit more on your credit analysis as well?
Sure, sure. I think, if we go to the credit, the investment process slide, so what we, yeah, so, so this is, this is a lot of, balls, right? A lot of circle here, but, to the heart of our, investment style is actually credit analysis. So we, look at the whole universe that's available. And I mentioned just now, most of the corporate Suku are actually, Sukuk, most of the corporate bonds are actually in Sukuk format. So, we have that universe there. And then we look at the, credit analysis. And I think our credit analysis is also leveraging on our global, I mentioned just now as well. So I think, other than, looking at the financials, we also do what I find, very useful in order for us to avoid all the rating downgrades or rating
Mm-hmm,
defaults by doing a
mm-hmm,
forecasting. So for us, we actually do a forecasting, to about 3 to 5 years. Of course, for the project financing type, we do throughout the bond. For
mm-hmm.
corporates, yeah. So for corporates, actually, we do, up to 3 years to 5 years. So I think in terms of the forecasting, combined also with in terms of the ESG, we also put a lot of because I think some of the downgrades that we've seen here in this page slide currently is because of management. So I think we have been able to put that element of governance early, since we started. So in that sense also, we must like the management. We do, don't really typically buy a company that after issue, then you cannot get them anymore to actually give you feedback or
I see.
keep you. Yeah, so we're very, very particular about overall. So basically for us is overall, when we look at credit, and I think we benefit from the credit model. So basically, of course, we do quantitative, right? So the
Yep.
qualitative part is the management part, and the quantitative part is the one that we leverage our global, as well as we include all this forecasting, and also to a certain extent internal rating. So we do our own internal rating. Example that I give, Lafarge Cement, is because of our internal rating, basically.
I see, I see.
Yeah.
So you mentioned about duration, you mentioned about credit analysis. What are the key performance attributions to your fund performance?
Well, I think we like to use this to remember easily, right? So in terms of, we say 3 C's. C's for us are curve. Curve is to describe the yield just now. And I mentioned that so curve, credit, and then basically also contribution of asset allocation. So these three is definitely the core risk that we core risk, or risk of return, basically. So for us, in terms of the curve, we make sure that we are, at the right, duration, for example. So also, I think, it also got to do with, the mandate. So basically, for these funds that we manage, Franklin Malaysia Sukuk Fund, it's, I know that, I wanted to maintain a capital preservation is very important, because I know that our investors are probably the one that want from the fixed deposit. They probably make money from equity, from Bitcoin or something like that. But and after they make money, the profit, they want something higher than fixed deposit. Again, fixed deposit is about 1.8. So, so I know that kind of investors, we like something that's about capital preservation. So in order to do that for me, the curve has to be, at the right curve, that kind of balance between risk and return. So I think, that's why I think for me, it's basically around 4 years kind of duration. So even if we buy something, it's within the 3 to 7 years bond for this fund.
Okay.
Yeah. And then in terms of credit, again, credit, it's a core. So if I were to describe how much credit in all these three, so I would say 60% credit. 20% curve, and then the other 20%, because we put a lot of effort in terms of credit. That's why, since we start managing local bond in Malaysia for Franklin Templeton. Of course, I've been managing it before in previous organization, but in Franklin, the last 10 years since we're managing, we didn't really have any major downgrade. We, of course, no default and no major downgrade
That's
because
good.
of that. Yeah. So, it's credit is a core of what we do. Um, and I think in terms of contribution of asset allocation is quite, is basically in terms of, do you want to buy government bonds or you want to buy corporate bonds? So I think, in anticipation of, the volatility, and again, preserving the capital, we like to be, more in the middle, more, at a 4 years, similar to the benchmark of this, which is 3 to 7 years, as well as managing that duration more towards corporate Sukuk, less to Suku. I think we basically have a circle of about maybe 10%. The rest is all invested in good corporate Sukuk. Yeah. So that's why I think we were not that much affected by the recent movements. Yeah.
Okay, so is that how your portfolio is positioned right now?
And the answer
Yes.
is yes. The portfolio now is about 4 years in terms of duration. That's against the benchmark of about about 4.3 for the bond pricing agency, 3 to 7 years. So yeah, so basically it still reflect. I have approximately, in terms of asset allocation, less than 10% now in circa 10% in government securities. And, we maintain cash of about 2 to 5. The reason is, because, we need to cater for redemption. Redemption, just like, it's just T+4. So in 4 days, we are able to pay you back. So yeah, so I think it currently still reflects. Yeah.
I think you mentioned a lot about your portfolio positioning already. What about how is your portfolio uh, positioned to capture some of the opportunities that you see in Malaysian Sukuk? Or what are the opportunities that you see, and how are you capturing this right now?
Yes, that's why I think it's the right opportunity now to buy Sukuk, because the yield have adjusted. I mentioned just now, right? The
Yep.
rate have moved
Yes.
higher. The whole curve have moved
Yes.
higher, and then in terms, and the beauty, and in terms of the the spread of the corporates now, when they need to borrow, they have to pay. So usually, before this, I think in 2020, you have a double A3 bond. Basically just the spread is just about 80 basis points. So let's say you have 2% of a certain of MGS. You only get 2.8 for a 3-year bond, for example. Now, because if we go to the middle, for example, the 3 years have been about 3%, and the spread have adjusted from that, 80 basis point to 140 basis point. So now you get 4.4, for about 5 years, for example. So, there's a lot of, so to me, it's an opportunity now. So you have, you have a adjusted yield higher,
Yep.
you have a higher spread. So, and, you get so much better level. Again, this funds, if you put in fixed deposit, for example, at
Yeah.
1.8, right? So, you get, just buying bonds, you get 4%. That's 200, 250 basis point, right? So it's anyway better for me, because, if they pay you coupons, right? And I think, retail and high net worth have realized this. That's why, you can
Mm-hmm.
see a lot of, bonds in an odd amount, we call it, being done. So I think in terms of my strategy is, tenor wise, I'm managing, taking opportunity, and I feel that the 5 to 7 years, tenor, that is basically have that kink there that is actually pretty attractive. And in terms of asset allocation, I think, we maintain, we buy corporate Suku that adjusted spread, in terms of but I think in terms of security selection, for now, we prefer the names that we are familiar with. I think, names like Gamuda, IGM, that kind of name that everybody knows, right? So because we want liquidity, these funds, that we manage actually pay, dividend, every quarter. So in a way that we also have to trade to, in order for us, and it's only payable from the gain. So, for Franklin Malaysia Sukuk Fund, so we need to trade to actually realize the gain, and we have been paying consistently every 3 months for the last 5 years since we started. Even the first month, that we launched the fund, we straight away pay. So, you get that regular income distribution basically. And I think duration, are still maintained, neutral. We call it neutral to the benchmark. So if the benchmark is 4.3, we are there. So, to be able to capture the opportunities that you talk about. Yeah.
I see. Do you see any chance that you mentioned that the spreads have widened and spiked? Do you see any chance of it close, like narrowing down again? Then that would actually help boost some of the bond prices, right?
Yes, that's right. So yes, I think, that's you can already see that's slowly happening now. That the
Oh,
curve,
okay.
yeah, that's right. The curve, the spread, between MGS and the corporate issuance have started to, because I think it's also domestic factors, basically the demand, kind of, sideways in the first quarter. Issues domestically, for example, ICNA withdrawal, and then there's
Yep.
perception that, the market do not have enough money, but that is basically over. So I think, you can see a lot more liquidity, a lot more demand came back in April. It was a very busy month for us as well, capturing all these bonds that give us higher spread. And I think, you can basically see already that is the spread, beginning to tighten. You can already make money, whatever that was issued before at 140, maybe now slowly adjusted to about 130, 120, something like that. Yeah. We started to
Does,
adjust.
does this spread help to cushion some of the, let's say, uh, interest rate hikes or rising yield environment going forward?
Ye-
Will this?
Yes, so that's basically, in a way that, it adjusted lower, you make money for your bonds. But, even if the yields on the MGS side, that I think, the government bond side is continue going to be volatile. That I think, because, it's really, moving in tandem with treasuries, with the US Treasury. So I think that will be volatile. But if your spread is, fat enough, so basically it can cushion. So that's why I think, our strategy is to basically be invested in corporate Suku and ensure that the credits are intact, and that really something that we are comfortable with overall, in terms of not just the the financials, but basically the management, the sector. I think all in, we must be comfortable with the credit before we invest. Yeah.
Okay. Could it be that the widening of a spread is an indicator of increased credit risk, or do you think it's overblown and actually now actually is the credit risk hasn't really gone up so much, but the yields or the spread have gone up so much. It's you can say it's undervalued right now. Do you
Yeah.
think so?
I think, because of that, I mentioned just now, the perception that the liquidity, the demand is less, because because of the the lack of domestic liquidity, because
Mm-hmm.
of things like institutional lack of institutional participation, especially the
So it's not
perception.
because of
Yeah.
increased credit risk.
No, it's not because of. In fact, I think as the we are expecting well, hopefully, right? The worst is behind us in terms of economic downturn, right? This year, we are expecting 6% to 7.5%, right, in terms of GDP growth, right? So meaning that the economy is getting better. So that is actually better for credit. I mean, a
I
credit.
see.
Yeah, it's credit is so it's to me is technical because of the perception that we don't have enough liquidity, EPF is not buying, other big investors are not buying, because of that. So that's why I think the price, the spread kind of adjusted. But actually in the we are bullish, more bullish corporate Sukuk now, corporate bond, because the if we have the economy recovers, I think definitely we will the credit will outperform.
Okay, thanks, Hanifa. Mm, I think let's move on to the Q&A from
Sure.
the the audiences. The first one will be which sectors or issuers within Malaysia corporate bond sukuk space that you are avoiding due to credit concern.
Yeah, I think we are avoiding a few sector, namely I think the property sector. So though we do have some, but very very selective. But overall, I think the property sector have some cash flow issues. They are not able to sell the property. So there's a property overhang, kind of. So I think we are very, very choosy in terms of the property names that we are exposed to. Construction to a certain extent, but I think it looks probably better now. And I think one thing about construction, the companies that are able to tap the bond market are the big ones. The big ones like I mentioned, name just now, like Gamuda, IGM. Which we pretty much comfortable. Other than that, I think we are in a way underweight construction as well.
I see, I see. And we have another question which I think you have addressed already, but I just repeat it, see you got anything to add. So in the long term, are investors better off holding on to cash right now and only buy sukuk or bonds in 1 or 2 years after you have rise further?
Well, that's the thing, to me, you put the FD now, you basically, I don't know, 1 year, 1.8 probably, right? I think 1.9,
Yeah.
definitely below 2. So why do you want to invest at 2% when can be invested with something safer, just slightly longer, tenor, and giving you, I think average for our funds, because we maintain it in the middle, right? So we didn't really take that much duration risk. It's about 4.5. And I think, this year, because to me, the rate have adjusted higher. So where we go
Yep.
from here, there will be volatility. I'm not, saying that there won't be any volatility. That's normal, the risk return, right? But it will not be that big, a big jump that what we have seen. By the end of the day, I think the movement that we are seeing now because of the US recovery that led to expectation that inflation will be higher in the US. But locally, if we are projecting 6%, 7.5%, but a lot of the probably it's not as our recovery is not as aggressive as the US, for example. So to me, we will be in this low interest rate environment, and Benagar have alluded to many times that we're going to be sportive of the market and things like that, right? So to me, keep, why not invest in bonds? I already mentioned that, the yield level is adjusted, the credit is, basically looking better with higher spread. You are in a much better position compared to, buying bonds last year. So I think you should actually give a bond consideration. Yeah.
Yep. And I think to a certain extent, the yield, the rising, the bond yields right now have already sort of priced in the rising yields or potential interest rate hikes. Am I safe to
Yes,
say
that's
that?
right. So I think potential interest rate hike is not actually, I don't think there's any rate hike, is going to be. In fact, I think in the US they mentioned 2023, that's 2 years, right? So I think for us, with what's happening in our macroeconomic background, I don't think we can afford to actually raise rates at this point. So, not in the cards. So that's why I think, at this point, when, bond is giving you 4.5, it's a better bet than, invest in, fixed deposit that returns less than 2. So you get 250 basis points for, in a portfolio that basically, have that element of capital preservation similar to deposits. But of course, you have to choose. I'm not saying that all bonds funds are the same, because there are a lot. And if you see in the first quarter, you can see a vast difference in performance, right? Now long sure invest in long tenor, that they are at the mountain, at the peak of the mountain, as well as probably don't have the right gear, because that they have bonds that basically downgraded. So sure, I think for sure it's these two elements that actually put some of the one funds down. So you have to basically, I think, do a little bit more analysis and make sure that the funds is positioned to your risk appetite, basically. Yeah, so that you just want something that earn higher than fixed deposit, 250, at 4.5, which I think is not, it's not low, because if you look at some of the big asset management, state asset management, less than 4, right, for a yearly dividend, that's 95% equity. This is a bond fund that give similar return. So risk return wise, you choose which one is better. Yeah.
Yeah, yep, definitely. Okay, next question. I think this is interesting question. How does Franklin Templeton's Sukuk fund differ from other Sukuk fund? Maybe you can share a bit of your AUM and your how many credit analysts or portfolio managers you have, and
I see. In
how
terms
you
of the team,
differentiate from other fund houses as well. Yeah.
I think definitely I mentioned the differentiation for us is our global presence. And, basically our, there are for investment, personnel in Kuala Lumpur office, there are 6 of us, so including equity. So, but I include them because we, also leverage on them, because a lot of the issuance are basically a public listed company, right? So sometimes we make a joint, well, before COVID, we actually make a joint, site visit with the equity team. So in terms of differentiation, again, as we leverage on the our global equity, global teams, global fixed income team. In fact, our analysts, in Malaysia, do not just cover Malaysian credits. We cover, credit based on sector. For example, our analysts with me, also cover, banks. She cover banks in Asia, so banks in Korea, banks in Singapore, other, of course, including our own banks. So, in terms of and not just cover, actually have metrics reporting to our head of credit for international based in London. So that's how we work. It's not like, I just, so it's actually via metrics reporting line as well. So in a way that, um, the conversations are frequent, you have a guidance from how they see it from the International Financial Center. So I think that is definitely differentiate us compared to our peers, especially the local houses. Yeah.
I
And
see, I see.
yeah, so again, I think in terms of credit, in terms of I didn't mention macro. That's also a big part, of how we position our funds, because that's how we determine, how like we have what we call fixed income. First, we call it fixed income strategy a team that we meet, well, actually at 11 p.m. Every 2 weeks, and I
11
think,
p.m.
yeah, I know, being part of the global, that's we have to get used to that. So basically, we discuss about treasury. Of course, that when we are seeing a treasury about 1.7, then probably, I think in general, the feeling is that, among us in the global team, that treasury is probably, in if it move, probably will touch 2 maximum before it's actually, pulling back. So we do expect that. That's why I think in terms of positioning, it affected us as well. Like I said, at the moment, the what happened in the US Treasury not just influenced Malaysia but globally.
Okay. Do you look at external ratings at all by those rating agencies?
Well, we subscribe to all, but we definitely, just use it in terms of, information. We do our own. We have a credit equity model, we call it, with a lot of forecasting that is being done by our own analysts. So this credit model has been with us. Of course, we adjusted, as we go along, to fit the local nuances, basically. But it's actually, a credit model that originate from our global offices. Yeah.
Okay. In terms of credit, which credit component is being placed as the utmost importance?
Definitely financials. I think for us, in terms of, yeah, so I think if you look at this slide here, in terms of the financials, quantitative, forecasting, that's the most important for us. But of course, we have the other elements, we have of governance. I mentioned, some of the downgraded bonds, I feel, is actually a governance issue, right? So, that's not easy to determine, basically. So you need to have a certain guidance, in order to basically spot that. Because, bonds sometimes, as we go along, the deterioration happen maybe 2 years, down the road, right? So I think for us, that, but if you are able to catch that governance part early, you probably have be able to avoid, because once it deteriorate, right, max, right, no way you can sell, right? So you just have to keep and ride, along with it, for example. Yeah. So I think, quantitative, especially forecasting, is the main consideration in our credit analysis. Yeah.
Okay. We have a few more questions? Okay. So
Sure.
there's one that mentioned about Max 2 bonds.
Mm.
Are you familiar with Max 2 bonds?
Well, as a market player, I have to basically, know what's going on. So, Max 2, I guess, there's a cash flow issues there. But I think
I think
they,
the question is quite specific. They
uh,
mentioned that if a bond fund is holding this Max 2 bond, which was downgraded, what should investors do?
oh, well, so basically, to me, that is already valued at a very low level. So
Okay.
from now, they are going through some restructuring, right? So,
Yes.
if that, I wouldn't buy, at this point, because it's still uncertain what is going to happen, right? Because until they secure a funding, they are not able to be, to move from where they are at the moment. But assuming that they are able to, then I think, the rating probably will be, will improve. But for now, it's really uncertain. It really, they are not able to I think they talk about this funding for the last 1 year actually. So, it's not happening, so it probably also a trust issues already, right? Because who wants to lend to, if there's governance concern, right? So if they are not able to get, then the inevitable happen, which is default. But hopefully it doesn't, reach there. Hopefully, there are some, white knights, to basically, improve this bond. Although I don't own it, but I have, I think a lot of my peers have it. So as an industry, we not want Sukuk to be default, right? So I think because it's a large bond, yeah.
Okay. Do you ever consider green energy bonds like Park or
Uh,
any new other players?
yeah, so I think that's I think if you ask me about the industry just now, right? The happening of the industry. Actually, this is ESG is number 4. So to me, you see a lot of basic interest to invest in ESG, and I think this sustainable, responsible investment, Suku SRI Suku is the new thing. So I think in terms, yeah. So I think in fact, I think we can already see slowly, but surely, that people are selling, IPP with coal to buy green energy. So I think it's very, very important for us too, a very important element. So we don't, we still buy into a coal, for example, Tenaga, for example, but as long as ESG wise, there's some progress. So if they can demonstrate that they are basically a company can demonstrate that they are actually reducing their coal, increasing their solar, for example, will still be invested in that. So it is a big thing, in terms of but of course, I think if we look at the list of downgrade just now, there's some, I think, initial problems with solar power, in terms of quantum solar, for example, right? In the beginning, because this new, they didn't anticipate that the timing that they said that they will complete the construction is just too short. So because of that, they were downgraded but upgraded back. So I think, but now I think, the markets are more familiar after 2-3 years of this energy, green energy. So I think going forward, I think the demand is actually pretty good for ESG. So I think that's the next trend going forward.
Okay, last question. So this is also quite interesting. Like, would the factors that affect bond yields affect Sukuk yields as well? Do they move in tandem or different, or there are other things to consider for Sukuk?
It move actually it move because I think Sukkot is also move the same way, but what make it more in a way less volatile is
I see.
because of the technical that I mentioned just now, demand versus supply. Because if I'm a Sukkot, if I'm institutional clients like Tabung Haji, right, I can only buy Sukkot, right? So that's, and a lot of institutional clients now are increasing that part. A lot of them are starting to invest in and have their mandate more in terms of Sukuk mandate. So that's created a lot of demand, chasing this supply. So because of that, in terms of the volatility or stability, I would say Sukuk is basically more resilient compared to the conventional side. And another thing is actually in terms of the offshore, we have a lot of offshore investors into our government bond side, especially MGS. So because of probably lack of understanding, the offshore normally just buy MGS and ignore GRI. So so it becomes a situation where when they exited MGS, right? And usually for GRI, which is dominated by onshore, you unless you are a bank with a cut loss position, you don't really cut loss. So as a result, it's more volatile for the conventional bonds. Yeah, although it behaved the same, but in terms of the severity of the movement, Suku, I think, can withstand the volatility a lot better than the conventional.
Oh, that's good to hear. I think that's all the questions we have today. We now come to the end of the session. Thank you all the audience for your time. I hope you have learned a lot during this session about Malaysia Sukuk and bonds. And if you have any further questions, you can always email to us at clienthelp.my@fundsupermart.com.my. Thanks, Hanifa, for your time.
Thank you everyone. Thank you for listening
Thank
in.
you for your time.
Bye. Stay safe.
Bye-bye.